Okay, Mike, hang on, because I want to bring in Sireen Hajj, the analyst with Credit Agricole, Bloomberg Best. Sireen, thanks so much for joining us on the phone. And I want to pick up where Mike just left off. I mean, do you think that we are possibly facing a double dip here in the housing market?
We're not expecting a double dip at this point. We do believe that housing prices will continue to decline. We think it's going to take some time before we see a solid recovery in housing, not until 2012. However, we don't believe that we will see a double dip scenario given the gradual improvement in the economy and slow improvement in employment.
And you said housing, you mentioned that recovery in 2012. It won't be meaningful until then. Describe meaningful for me.
Basically, which means when we start seeing home prices to increase, we see some of that inventory on the market to decline a little bit faster than we have seen lately, and also we don't see this high rate of foreclosure filings.
One of the questions is what turns that around? When you look at the declines, they're rapidly outpacing the gains. Only 4 cities saw gains during the month of November. 16 cities declined, and the 4 worst cities all fell by more than 7%.
Well, the thing is with housing that it's very regional, and you do have some regions that, yes, they are still suffering. However, if you look at it in other areas, for example, the New York area has not been so bad. Other areas, other states have not been so bad, and we think that, again, the improvement in employment, people are going to be able to obtain more credit, buy more homes, and it should definitely see a pickup.
Sireen, one of the things that you've said before is that housing remains the biggest risk to the economic recovery. But others have argued, though, that housing is becoming a smaller and smaller part of the economy, that it just doesn't matter as much anymore. Why do you stand on the other side?
Well, because still housing is a big part of everybody or people's investment. Consumers still look at their homes as one of their most important investments throughout their lifetimes. And, with declining home prices, this could have a negative wealth effect on consumers and consumer spending. So that remains a pretty big risk in our view.
Well, how far down would we have to see prices go to get that risk in place? Because we've seen prices fall for 5 months now, but retail sales have been going up.
Well, we expect home prices to continue to decline about 4% this year. So I think beyond that, we would start to worry.
And Sireen, just lastly, something interesting you mentioned about, the wealth effect of housing, though. Some are arguing, though, that you can just forget about a housing-led economic recovery, that we no longer can rely on our house price to increase our wealth and our spending.
Well, perhaps it won't increase the wealth and spending as strongly as it did before the recession. However, you have about 23% of people who are underwater on their mortgages, meaning they owe more on their home than it's actually worth. And this has a very strong negative wealth effect on people as they tend to save more and spend less.
Sireen, thank you so much. I appreciate you joining us. Sireen Hajj, Bloomberg Best with Credit Agricole.